just for the benefit of our viewers, what would your risk management strategy be?
We are very clearly saying that it's a tactical long and opportunity short, which means my entire investment horizon is not going to be long term. I'm going to talk about short term and medium term investment horizon.
So you're saying SIFs are lesser volatile than mutual funds?
It's the way you run it. We will run it in this manner that I will bring down the beta of our portfolio.
And this has never been there before
No.
for retail investors?
No, it's not. The first time. Why retail investors should be deprived of such products?
Correct.
Where HNIs are getting that opportunity.
But why did they keep this minimum 10 lakh ticket size?
I think they just want to differentiate between mutual fund and the PMSAIF also. Somewhere in between that product has come.
You all have started the QSIF, right? How is it different from what other mutual fund or other fund houses are doing? Hey folks, welcome to our special knowledge series where we have been talking about the latest product in town, which is SIFs, the specialized investment funds. As we know, and as we've been talking about in the past as well, this is a product where you can now have exposure as a retail investor with a minimum ticket size of 10 lakhs. You can have exposure to even the derivative side of the market where naked shorting is allowed. So, it's kind of a different product, and Sandeep Tandon has been speaking to us about it as well. Sandeep, just to understand a little more about this, of course, it's public knowledge about SIFs and a lot of people are talking about it. But just to explain a little more in detail about how SIFs differ from mutual funds and what category of investors should look at it.
See, very simple. SIF and mutual fund, marginal difference. And the marginal difference is that you have additional feature of 25% shorting. And when I say shorting, which means even naked short you can do, even the stock which you don't own, you can still sell and try to create alpha out of it, which is not available in the mutual fund industry. Okay, but it obviously comes with the risk also. So you also have to keep in mind that a lot of people have this perception that shorting can go against you. Yes, it can go mathematically, it can go against you. So it's up to you how you manage. See, this business about SI will be very tricky and interesting. If you use the short as a strategic sort of thing, or let's say if I'm running continuous long short position, I don't like some stocks, so I'm short, that strategy may not work. Okay, because in shorting you can lose sizable money, but if you are shorting at right inflection point of the markets, okay, or either you do with your experience or you do with the help of analytics, then that can actually generate an alpha for you. Okay, let's say example, you're rolling a position for long position, you're rolling, let's say I'm saying example from a futures point of view. For last 6 months, 8 months, you like something and you are rolling your position or holding your position, and you got, let's say, 20% return in last 1 year. Now look at a scenario where short position, if you can time it better, then obviously you can generate that sort of return either 1 day also, sometime in 5 weeks, 5 days also, sometime in a 15 days period. So it's a very opportunist type of short if you can get it right. Because this product is not about that you have to run continuously long shorts. What regulator is saying that you don't have any compulsion to run long short product simultaneously. What is saying is up to you whether when you want to optimize this thing, when you want to capitalize this opportunity by creating short, which can be from a better risk management or it can be even for a source of alpha. It's up to us how we want to spot that opportunity. We are very vocal about it that we will going to use as an opportunity sort of approach, not running continuously short position. That is not be advisable also.
That was actually my next question. So at Quant, what is the plan? You have a product QSIF, you're also getting into this space. What would your strategy be? Because as you said, right, consistently running a short position also may not be the best strategy.
Yeah.
So for the benefit of our viewers, what would your risk management strategy be?
See, Sonia, let's understand let me explain you from mutual fund and this perspective, give you some answer. So like in mutual fund, we run, because mutual fund are long-term products, okay, for 5 years, 10 years, you come as an investor. We talk about core holding and non-core holding. So everybody has 70, 80%, 90% core position. 10, 20% people keep as a non-core, which sometimes people do call as a trading position or non-core position or tactical bets, okay. And it's up to us how you want to play. So basically all tactical bets and non-core position are taken from a short and medium term perspective. Your all core position are from long term. You say I'm going to hold this stock for 3 years, 5 years, 10 years. This is my long term core holding. All my tactical position could be very opportunist. Okay, we expect the next quarterly numbers to be good, or some event has happened, or some policy changes has happened, some global theme is going to play out. So you can do those things. Here, the way we are proposing to launch in our QSIP is all about tactical longs and opportunity short. We are saying that our entire portfolio will be tactical long. We are not going to run our core portfolio. Okay, because otherwise there's no differentiation between this and our mutual fund product. Okay, if I have the mutual funds product, I already have this option to have my core holding, then we want to differentiate this product. So we are very clearly saying that it's a tactical long and opportunity short. We are not going to run short position on continuous basis. Only on relative opportunity we want to capitalize this.
Okay, got it. So tactical long and opportunistic short. Can you tell us a little more about this high frequency versus low frequency? How should I understand this from an SIF perspective?
Yeah, it's an interesting point. See, let's understand our mutual fund framework first. So when we run our mutual fund through discretionary active strategy, and we have our own framework called VRT framework.
Yes,
okay,
you've spoken about that to me before.
Okay, so when we talk about, let's look at dissect the component, then I'll give the answer. When we talk about valuation analytics depending on your quarterly numbers, monthly numbers. Okay, so which means any data which is used for valuation analytics are low frequency, okay? Because anything which is not coming on minute to minute or continuous basis are high frequency. This is not coming on continuous basis and low frequency analytic. Similarly, risk appetite is largely macro data, which comes yearly, half yearly, monthly, quarterly, again low frequency, okay? So two important component, low frequency. Then third component is the liquidity analytics. In liquidity analytics, we do look at the daily volumes or the delivery volumes or the open interest, but that is also only 30% of that. 70% is how money shift from pension fund to hedge fund or from asset classes, and that data also comes with a lag effect. It comes on monthly. So we are talking about a scenario where in a VLRT framework 90% of my data is actually low frequency. And we are very okay with that because mutual fund is a product we are looking from a longer term perspective. And I say not from investor point of view, as a money manager perspective, all my thesis are core holding, long term holding, and hence low frequency we are very open. When you're talking about SIF or the QSIF product which we want to launch, we are saying that is the very tactical long and opportunity short position, or opportunity short we are looking at, which means my entire investment horizon is not going to be long term. I'm going to talk about short term and medium term investment horizon. Then only I can control the risk. Okay, because you have to look at everything from a risk perspective. I cannot predict the risk from 10 years perspective, but given the data or the high frequency data which we track, can you predict next 6 months, 3 months, or shorter duration? You can predict shorter duration far better or with more clarity than predicting something from 8, 10 years or 5-year perspective. When the entire thesis or the genesis we are coming from that we are saying tactical long and opportunity short, which means I'm only looking at short term and medium duration strategy, which clearly means it has to be dependent on high frequency data rather than the low frequency. That's the way the high frequency analytics comes into picture. So here the derivative data, all are high frequency, risk data, all are high frequency.
So just to give a practical example, suppose you are negative on the IT industry, for example, right? Because of all that's happening. So the short position that you will take will be for a limited period. It will be for like a tactical short position, maybe like 3 months, 6 months. And the long positions will be for a slightly longer term. Is that the right way to look at it?
Up to a certain extent, yes. Let's take a live example. We were very bearish on January 2025 itself, IT and multiple channel we talked about. We think vulnerability in IT is there, and we actually cut down our exposure to zilch in the entire IT space. At that moment, because my data points were not constructive and showing signs of vulnerability, at that stage, if I could, let's say if I could have running this product, then I could have created short position in the entire sector. Okay. Now the stock sectors have already corrected significantly. We will mark prices down 20-30%. If I have to say that whether I'm going to looking for a very strategic short at this point, the answer is no. Can I look for a event driven short position? Earnings quarters are coming. We expect that something is going to happen, or your data points are showcasing that here the vulnerability still exists. Then those positions we can still short. But as a strategy, the easy phase of shorting which was there in January, February is over for IT rather. In fact, we are looking for a buying opportunity out here. So we are looking for tactical long. So IT becomes a tactical long because now it has come to that most what we typically look at, hated zone, neglected zone. People have given up. People have just vomited in that space. Okay, those are the great point for us. Okay, now obviously we're not very aggressive, but if you ask me theoretically, if we're running this product, then I could have looking at going long on the IT basket as a tactical long position because we are still not very clear from long-term perspective of IT. But given the way data points have changed, currency has also depreciated sharply, everything has gone against that space. So it could be a tactical long. Maybe what can be, let's say if you are talking about today's context, opportunity short. Okay. So maybe you identify sectors like banking, private sector bank, grossly overowned, reasonable. I'm not saying they're expensive, but on relative basis, if I have to run a pair, then I will run long IT and short private sector bank, but not public sector. So that's what, if somebody asks me question, this is the position I will take as of today. For me, some of these data points are showcasing and they will take. That's the way the tactical long and opportunity short will come.
Okay. And in normal regular mutual funds, this is not possible because there's no naked shorting that
No,
can be
naked
done.
short.
There's
Only
no
you
shorting
can.
as well.
No, shorting you can do true shorting. When you can basically, if you have,
If you have the
let's say if you have Infosys and TCS in your portfolio, then can you short them? Yes. To protect the downside, yes, you can short them through futures route or options route. You can, but true hedging is allowed. Other option is that you go through indices route, where you buy any index, either Bank Nifty or Nifty puts, or you short Nifty futures. So that's another way. So hedging in mutual fund is allowed, but naked shorting is not allowed. In this product, like QSIF, when we're talking about the SIF, we look at both hedging is also allowed, over and above 25% shorting is also. Naked short of 25% is the unique feature.
And this has never been there before
No.
for retail investors
No,
to
it's not.
access.
The first time regulator. Actually, we are very grateful to regulator because taking this an innovation. You have to take step, because why retail investors should be deprived of such products?
Correct.
Where HNIs are getting that opportunity through
Through AIFs. But why did they keep this minimum 10 lakh ticket size?
I think they just want to differentiate between mutual fund and the PMSAIF also. Somewhere in between that product has come. Maybe who knows, it becomes popular and industry behaves in a very mature manner and these products also become, who knows, regulator can change it tomorrow. Okay.
Bring it lower,
Yeah.
you mean? Okay.
But as of now, we are not factoring, because I think it's a positioning is somewhere in between. It's a good positioning. See, let people also take some time to understand these products rather than just participating on immediately. So what regulator is saying, that there should be more who are more financially literate, who understand the shorting, who understand the risk related to naked short. They should be first investing these things rather than somebody who does not understand and straight away participating. So that could be a good strategy.
And slightly a more discerning investor who maybe has many years of investing under his belt to understand that even risk reward is not that
Yes.
easy, has
Yeah.
gone through maybe a couple of bear
Correct.
markets and etc. to
Yeah.
see some drawdowns, right?
Correct. So this type of product will help them, and I think it will take few years, from education point of view, just to digest in the experience also. People will wait and watch and see next 2-3 years how it shapes up. And that's the reason we are also not saying that you go all out. We are saying just start with minimum amount, so that this should be part of your portfolio and you experience how it plays out. So you will be the best judge how over a period of time this product has performed. Unless you experience, there's no point talking about.
Yeah. No, true, 100%. So as I said earlier, a lot of mutual fund houses have sort of started this product, and there's a lot of education around this product now as well. But how does one mutual fund differ from the other? Like, for example, you all have started the QSIF, right? How is it different from what other mutual fund or other fund houses are doing? I mean, is there a different strategy? Is it just a fund manager bias that I'm buying into, or the fund manager's sort of experience that I'm buying into? So how is your strategy different?
So as I explained, these products globally can be referred through beta neutral or market neutral or low vols or absolute return product. Various names can be different. It depending on the particular AMC or money manager, what strategy you're using. Where, let's say, some people are talking about making it completely absolute return product. Okay, which means idea is that I'll try to hedge as much as possible and try to generate absolute returns. Okay, which means low returns, but it has to be absolute. That's a one thought process. But we think it's not a great strategy, because somewhere you are getting an opportunity of creating short position, earning alpha out of it. So that's not a perfect strategy the way we understand. Second option is, like, some people will look at this product as an arbitrage plus product. You already have arbitrage. I will try, because in arbitrage product you have to be 100% arbitrage. Here you say that I'm going to use, let's say, 75% arbitrage and 25% directional or 10% directional, depending how you look at, and try to generate some option. That can be opportunity which you can look at. But the way I look at, but I have a very different, when I say Quant, QSIF has a different strategy. We are very clearly differentiating. We are saying for us, this product is beta management. We are bringing down the volatility of our product. So we are calling it the two twin objective is that lower volatility and lesser drawdown. These are only two twin objective which we are following in entire QSIF strategy. Whether we are launching our flexi cap first, then we launch a hybrid product, then we launch a Smith product, or any other product which come. Everything revolves around, because we already have a mutual fund. Okay, in mutual fund, my canvas is completely open.
So you're saying SIFs are lesser volatile than mutual funds?
It's the way you run it. We will run it in this manner that I will bring down the beta of our portfolio, and
how do you plan to do that?
So it's through shorting opportunity. Okay. So let's say I have explained earlier also. Let's reassess what SEBI is very clearly saying, that your gross exposure cannot exceed 100%. So if you have taken a call that you want to exercise this 25% future short options in the market or naked short, then you have to cut down your long exposure first. Gross long exposure has to be 75 and then 25%, which means you have cut down your net long exposure to 50%. So I have cut down my beta of my portfolio drastically. That's the first clear message. Second thing is up to us how you use the shorting opportunity. One way is that you run long short continuously on as a pair you want to run. we don't want to run as a pair.
You said that. You want the shorting opportunity to be
Yes.
lesser, shorter.
Because
duration.
I always seen in our Indian experience that shorting, if you don't cut on right time, you can lose sizable money, because shorting opportunity comes for few days or few weeks or sometime a day also. Okay, so it's up to us how you want to capitalize that. It should not happen that you miss out, that your call was right, you played also well, but you have not booked your profit, and then you are standing in a very awkward situation that you lost. Because in option, the theta decay also plays a very important role. So when we start using derivative product, let's say options, so price of the second or third derivative is also very important. Let's say the price is important, but the volatility forecast is also very important. Okay, a lot of people come and say, oh, we shorted, but I have not made money, because vols collapse after the event. Okay, the volatility which has spiked because you bought at higher vols point, and after the event vols has just collapsed. So though prices have corrected or rally, whichever way you are looking at, but you are not able to take advantage. And hence, and when you talk about SIF, your risk management capability and money management experience will play a very, very vital role.
So for the QSIF particularly that you folks are launching, there's a new investment framework that you're looking at called Markov.
Yes.
Can you just take us through that?
So Markov is actually based on a Russian mathematician who has designed based on the theory of probability. What it says that whatever the event, or let's say what was the number yesterday, based on yesterday data, I will only forecast the future. Okay, so it's what it means. Yesterday data capture previous day data. We are not going to historically, but previous day data is captured in this thing. So indirectly, he's also talking about weightage on the latest number, or more weightage on the exponential series aspect, and hence relatively quicker data or high frequency data. That's the one thought process. When we talk about Markov, well, the first terminology is that market microstructure. Okay, when you're talking about micro market structure, what it means, let's say in the media you're seeing a price of Tesco is flashing, the last traded price. If you go to a broker terminal, you can see the depth, 5 bid and 5 offers. If you're a high frequency trader or a large prop trader, you can subscribe additional data from NSE or BSC and you can see 50 depth. So you are talking about a more depth sort of thing, more granularity. Okay, so we are talking about micro market structure. If I say Wix number is X and then say how wall surface, okay, more granularity. Instead of saying yields, I say term structure, more granularity. So we are talking about market microstructure, another high frequency analytic. We are trying to look at the granularity aspect. That's the way M stand for. A stand for alternative data. Okay, how then? Because if we are looking at in alternative world today, we are living in the AI ML world. We can actually process lot many alternative data, which is not possible in the normal environment. R obviously stand for risk and analytics, but here risk analytics very, very important to role tracking online data, how the Greeks or the war number, the impact cost or anything. When you talk about pre-trade, post-trade, all sort of trade related analytics and risk analytics are going to play a very important role. So when you talk about C component, the cycle analytics. So we do look at long-term cycle. If you recollect, we have talking about how the 2020 to 30 will be a challenging phase, how the volatility will spike. So how you protect these things, because we do a lot of work on cycle analytics. So here we can bring, instead of looking only in a longer term cycle, we talk about short term, because we want to capitalize on shorter and medium duration also. So cycle analysts will going to play a very, very important role. Now O stand for objectivity analytics. Okay, now in short term, when we're talking about the entire thesis of this product is that we revolve around medium and short term perspective, and in short term market is driven by noise and narrative. How you filter in today's AI world, sometimes you don't know whether is that genuine news or not. So when we're talking about how objectively we can define these things, that is the way objectivity analytics comes into picture. Let's say any company results comes today and 100 analysts cover and 70 people have upgraded or 30 people have downgraded. Now if you get into debate why these 70 have upgraded, why 30, the subjectivity comes. When we at Quant we say objectivity is a religion, data is God. There's no space for subjectivity. So what we are saying objectively, 70% people upgraded, 30 people down. The ratio is that 70-30. It's very simple thing. Anything which I can quantify objectively, that's the part we're looking. Since you're talking about the derivative data, volatility aspect is going to play a very important to, unless you are able to look at the volatility analytics closely, or you are able to predict how the volatility will change over a period of next few months or few weeks and few days also. Okay, so those are important. So these are some of the high frequency analytics we have tried to showcase through Markov.
Okay, that's very interesting. So as a young investor, right, if most of the people who watch our shows are in this age group of 20 to 35 and are allocating some amount of money to mutual funds, etc., what would your ideal allocation be to SIFs versus mutual funds if someone has the capacity to allocate 10 lakhs?
Okay, fair point. It's a good question. See, with the way you look at, because this product itself is very new. Okay, what we are saying that if somebody has a 5-year horizon, then in next 5 years you should have 50% mutual fund allocation, you should have 50% SIF allocation. allocation. Why we are saying that 50% obviously looks very large number right now? Because this product brings some amount of uniqueness from a risk management point of view. And hence we are saying, if you look at the combination of both mutual fund as well as the SIF or QSIF, which we are talking about for our product, we are very clearly looking at opportunity, and this will balance your portfolio from a longer term perspective. And there's a reason why. Again, it also depends on your age profiling, risk profiling. Somebody has very young, has more risk appetite, then they should put more money on the mutual fund side, because that is meant for, it has potential. Here we are capping our upside in some manner, where we are not capping our upside in the mutual fund.
Okay, fair enough. Thank you so much, Sandeep. It
Yeah,
was
thanks,
an
Sonia.
absolute pleasure to learn from you, and all the best with your product as well.
Thanks a lot.
As is the case with many of your other products, I'm sure this one will do extremely well. But thank you so much for joining us.
Thanks.